Hello and welcome back to the FT here in Hong Kong. While the Japanese government works to rebuild the devastated northeast coast, Japanese companies are struggling to cope with the rising yen and falling demand from major trading partners. Peter Tasker from Arcus Research joins me now. Peter, thanks for joining us. Peter, Europe is the word on everyone's lips right now. Just how exposed is Japan to the problems in the Eurozone?
I think it's getting towards the pain limits now for Japanese exporters. It depends on the industry because you've got the double whammy of the strong yen plus the decline in demand from major markets. So put those two together and it's quite painful. Furthermore, Japan's major head-to-head competitor in many industries is Korea, and the Korean won has been declining against the dollar. So put that together and you've got a significant increase in the competitiveness of Korean companies vis-a-vis Japan.
What else can Japan do on the yen?
Well, it can intervene, but sporadic intervention has limited effect, and generally speaking, you have a few months of pause, then the yen strengthens again. That's been the history to date. So you need much more of a statement, and a statement that's backed up by action.
Domestically, the next couple of years in Japan is likely to be characterized by reconstruction spending. How much can that rebuilding offset the impact of things that are happening outside Japan? Japan
is actually, as an economy, is not as exposed to the rest of the world as you might think. Exports probably about 15% of GDP, much higher. Korea is over 40%. But the rebuilding of the Tohoku region, I think, is going to be significant to certain industries, but the overall macroeconomic effect will not be that great. The numbers just aren't big enough.
The economy has suffered 20 years of relatively slow growth. Some people call them lost decades. Are there any lessons that the rest of the world should be learning from the Japanese experience?
Well, in some ways, what the rest of the world is seeing now is very similar to Japanese experience, in that you have a bubble which bursts, then you have deleveraging by the private sector as a whole, and that automatically means the government sector has to go into deficit. But people tend to get very disturbed by that, and they see government indebtedness rising, and then they try to cut spending or raise taxes. So then you get into a scenario of very, very low growth, and that has an effect on expectations, and it becomes difficult ever to exit that. So my view is that you actually have to hit the economy with every form of stimulus that you can get to prevent that taking place, because once it's taken place, it's very hard to change expectations.
Is there still an opportunity for those countries to avoid the Japanese experience?
Yes, I think so. I think so. And one thing that is different is that in the Western countries, in fact in the world as a whole, we had two bubbles successively rather than at the same time. We had an equity market bubble which ended in the year 2000 and has basically been imploding ever since. But after that we had a property and credit bubble. So we had two different bubbles and they weren't coterminous. Japan had its property bubble and equity bubble at the same time. They burst together, and that was very, very serious damage. In Europe, the US, the rest of the world, equity markets are just not that expensive. The real estate was very expensive and in some cases remains very expensive.
So what's the answer?
The answer is to try to keep nominal growth as high as possible by putting your pedal to the metal. And that's very unpopular at the moment. People seem almost to want to wish a bad outcome, which I think is a huge mistake because everybody loses from that.
Peter, thank you very much for joining us.
My pleasure.
And you can keep up with all the FT's latest Japan coverage at ft.com/Japan.